Hi everyone, this is Paul Lange with another topic in a series of free online videos you can find at disciplinetradingstrategies.com on the free stuff page. This topic is how to control slippage, and it's one that I get frequent questions about and is an important topic near and dear to my heart. If you like this video, be sure to check out the variety of videos and other free information at the DTS website on the free stuff page. Also, be sure to attend an event that I do every 6 weeks for students who sign up for the actual seminars. They start with a half-day class on Friday called Introduction to Mastering Technical Analysis, and I invite everyone to attend that class. It's great information and covers some topics that are not taught anywhere else. If you like everything you hear, consider gaining the knowledge you need to trade by taking my 3 one-day classes. You can read about them on the website on the services page. And finally, if you are not a DTS member, be sure to sign up. It's free, without a credit card needed, and you don't even need to leave your name. It takes about 6 seconds. You will have the benefits of receiving a free weekly letter about the market, and also you will be invited to free educational DTS events. I said this topic was near and dear to my heart because I've always hated slippage from day one for me. There are many things you do in the market that you may eventually consider to be foolish, but at least there's always a trade-off. If you take a very aggressive trade, you may eventually have a reward to it. But slippage is simply throwing money away. There is no positive side to slippage. From day one, I've always tried to trade in a way that avoids slippage as much as possible, but sometimes you need tricks to minimize it because you have to have the trade. Slippage is very simply the difference between where you try to enter a position and where you actually get filled. It can be frustrating sometimes if you're trading the wrong types of stocks or in the wrong way. You achieve no slippage when you get filled at the offer when buying or at the bid when selling. Note that the spread, which is the difference between the bid and the offer, may cost you money eventually between your entry and your exit price, but it is different than slippage. View the video on tradability of stocks to get a better understanding of slippage, depth, and liquidity. Can you consistently trade with no slippage at all? The answer to that question is yes, absolutely, positively, no slippage whatsoever. There's 2 ways to do it. We're going to take a look in this video on how to trade with no slippage at all, how to trade with almost no slippage, and how to minimize slippage when you have to have the trade. The variables we'll look at in order to understand this process is number 1, the share size that you need, the overall liquidity and tradability of the stock, the types of plays that you trade, in other words, the strategies and stops that you use, the time of the day, the techniques you might use, and the efficiency of your trading platform, computer, and internet. No slippage. How to trade with no slippage. Number 1, simply use a limit order. If you're not familiar with it, a limit order says that I want to buy this particular stock, but I do not want to pay more than X price. It's kind of cheating in a way because there's a downside to a limit order, and that is that you may not get the play. It could go beyond your limit and you will never get filled. But keep in mind that a limit order is a way to absolutely totally eliminate slippage, or in the alternative to contain it to a number that you feel is acceptable. There's a second way to eliminate slippage where you will get filled virtually 100% of the time, and that is to trade very liquid stocks. This is the ultimate answer to eliminating slippage and still have great tradability. How many simples do you think trade 8 million shares a day? Well, the answer is it's about 100 right now. And there are 250 that trade at least 4 million shares a day. That's pretty liquid. You can buy thousands of shares of most of these stocks in a second with no slippage at all. So one answer could be simply is to contain your universe to these 250 stocks, or maybe slightly more or slightly less, depending upon how many shares you actually end up trading, based on the other things we're going to look at in just a minute. The next thing that is important when you're trying to minimize slippage if you have to trade more illiquid stocks is to look at the strategies that you are using. You may not want to change your strategies, but understand that some strategies simply create more slippage than other strategies do. The most difficult entries for slippage are those high of the day breakouts, followed by any type of a breakout that has a very thin base to it. And this is especially true if you're doing them earlier in the morning. Buying on pullbacks helps to minimize slippage, and easier still are pullback plays on secondary entries or legging in before triggers. Some of these concepts are a little complicated and they're taught in seminars, but some of you understand what some of these mean. The second thing is the type of play. To minimize slippage, scalps have smaller targets and requires tighter stops. Tighter stops require higher share size. These higher share size trades, of course, will increase slippage. In other words, taking a 1-minute DTS breakout will increase slippage as compared to a longer day trade that will decrease slippage, or swing trades because of the increased targets, the increased size of the stop, and the smaller share size. This will decrease slippage even more. The time of the day is very important. The first 5 minutes of the day can be deadly for slippage. It's known as the Wild West. There are almost no rules out there. Even the first 30 minutes of the day can be tough on some stocks, especially if they're not normally well traded. Slow periods during lunch can be the next most difficult for the opposite reason, not because of huge volatility, but because of the lack of volatility. The best time to decrease slippage is during those higher volume morning periods, but after the first 5 to 30 minutes. Some additional things to look at. If in spite of all the above you need to deal with slippage, there are other more advanced concepts to explore. Anticipatory entries, there are two different kinds, as well as legging in or legging out. The pros and cons of limit orders, using them in a variety of different ways. Advanced management tactics to help avoid the rush when trying to get into a play. And finally, having everything totally up to speed, such as your trading platform, your connection speed, and your computer. How important is this topic? Take a look at this final slide. Assume that you learn to save only 1 penny of slippage per trade, not entry and exit, just per trade. Assume you take 5 positions a day as a day trader at 1,000 shares per trade on average. 1 cent per 1,000 shares per 1 entry is $10 a trade. $10 a trade times 5 positions is $50 a day, and $50 a day times 20 trading days is $1,000 a month, or $12,000 a year in savings by understanding slippage. And imagine how that adds up if your slippage is more than only on 1 penny per entry. Hope you've enjoyed this topic. This has been Controlling Slippage with Paul Lange from Disciplined Trading Strategies.